What's up everyone, and welcome back to the channel. If you are new here, welcome. This is the place where we break down big economic events and global financial trends in a way that actually makes sense. No boring textbook stuff, just real talk about what's happening in the world. And today, we are going deep on one of the most important stories of 2026 that most people still don't fully understand. We are talking about the Strait of Hormuz, what it means for global oil supply, why oil could hit $150 a barrel, and why that exact scenario could send gold prices to levels we have never seen before. This is a major breakdown, so grab your coffee, settle in, and let's get into it. Let's start with the basics, because a lot of people hear Strait of Hormuz and kind of glaze over. Imagine the entire world's oil supply is like water flowing through a garden hose, and someone puts their thumb over the end of that hose, that's the Strait of Hormuz. This is a narrow stretch of water, only 33 kilometers wide at its narrowest point, sitting between Iran and Oman. And through that tiny strip of ocean, approximately 20% of all the oil traded in the entire world passes every single day. Countries like Japan, South Korea, India and much of Europe depend on oil that passes through this strait. The moment something disrupts that flow, whether it's military conflict, a blockade, or even just the credible threat of disruption, the whole global energy market starts shaking. And while the strait has been threatened before, the situation has escalated recently to a point that has veteran analysts watching with serious concern. Right now, oil is trading in a manageable range of $80 to $90, but $150 sounds extreme. So let's walk through the math step. One is the supply shock. If the strait is even partially disrupted, you remove nearly 20 million barrels of oil per day almost overnight. That's like pulling the engine out of a car and asking it to still drive. Strategic reserves are currently too low to bridge a long gap. Step 2 is the lack of alternatives. Rerouting tankers around the Arabian Peninsula or Africa adds weeks to shipping times and massive costs. Insurance rates for ships in the Red Sea have already been climbing due to regional instability, making every barrel significantly more expensive. Step 3 is the panic premium. Markets price in fear and in a crisis. Traders add a risk premium that can double prices in weeks. This chain reaction is what turns expensive gas into a $6,000 gold price. Gold and oil have a historic relationship. When energy spikes, everything gets more expensive, from the fertilizer for your food to the fuel for shipping. That is the definition of inflation, and it eats your purchasing power. Fast. Domino 2 is the central bank trap. They have to raise rates to fight inflation, but doing so during an energy crisis risks a total recession. When the system gets stressed, governments often print more money to stimulate the economy. But every time more dollars or euros flood the system, the value of each individual unit goes down. Gold, on the other hand, cannot be printed. It has been humanity's store of value for thousands of years because it's finite. When currencies weaken and inflation runs hot, money flows into gold as a safe haven from paper assets. Another layer is the US dollar, which is already under pressure from massive debt levels, and the trend of de-dollarization. Nations in the BRICS bloc are actively exploring non-dollar trades, and central banks in China, India and Turkey have been buying gold at record rates. They are signaling a lack of confidence in the fiat system. Add a Hormuz crisis to this fire, and you have a massive accelerant for gold prices. Is $6,000 certain? No. But it's a realistic scenario in a sustained crisis. Bank of America and JP Morgan have already modeled gold moving toward $4,000 and $5,000 in high-stress environments. If oil stays at $150, the flight to safety could easily push gold to that $6,000 mark, as investors look for anything that holds real value while paper markets crumble. For the average person, this means your cost of living will rise before you officially notice it. Gasoline spikes first, then groceries, then electricity. Savings in cash lose value silently every single month because your money buys less than it did before. This is why wealth preservation matters. It's not about getting rich quick. It's about making sure your hard-earned money doesn't disappear into thin air. Hard assets like gold and real estate tend to act as shields in these environments. The window of opportunity to protect yourself is usually narrow. Because by the time the mainstream media is screaming about a crisis, the big moves have already happened. The people who come out ahead are those who recognize the macro trends early and act with conviction, rather than trying to time the market perfectly. The world order built on globalized free trade is shifting, and gold sites at the intersection of that change. It is the one asset no single government controls, and it doesn't depend on a promise to pay when trust breaks down. Gold is where value goes. The Strait of Hormuz crisis isn't just about oil, it's a signal in a larger game of economic chess where your savings are at stake. To wrap up, remember the key takeaways. The Strait is the world's biggest energy choke point. Any closure sends oil to 150, which triggers a wave of global inflation that forces central banks into a corner. Weak currencies and high uncertainty drive record demand for gold, which is why that $6,000 price target is now a serious part of the conversation among professional analysts. I'm not here to scare you. I'm here to make sure you are informed and making clear-headed decisions based on logic. Understanding these drivers is the best thing you can do for your financial future. Do your own research, stay curious, and don't let the complexity of the market stop you from protecting what you've built. Thanks for watching. Hit the like button, and I will see you in the next one. Take care.